Well, hello again, everybody. This is John Norris at Trading Perspectives. As always, we have our good friends Sam Clement and Courtney Trush. Y'all say hello.
How's it going?
Hey, John.
Hey, guys. You know, I got to tell you, it's a beautiful day here in central Alabama as we're talking here this morning. However, when you take a look at the world around us, particularly the banking world, it seems like there are a lot of dark clouds. You like the way I did that?
Oh,
you
yeah.
like that? Like that?
That was nice.
A little weather report. But unless you have really just not been paying attention to the news, particularly the business news, you probably heard something about Silicon Valley Bank, Signature Bank, maybe even Silvergate Bank. And then in the middle of the week, my goodness, there's problems with Credit Suisse and their banks on the bank list and watch list and all of that bad stuff. And gosh, you know, the media is making it out to be another revisit of 2008. It's kind of as Yogi Berra once said, Sam, it's like deja vu all over again.
That's right.
And for some of us who are actually in the workforce, that is quite scary.
It is quite scary indeed. However, when I took a look at what was going on in Silicon Valley Bank, it doesn't matter how much. It doesn't matter sometimes what you say. People are going to still respond to fear. And that unfortunately is kind of what I think the media is really kind of pushing out there. Fear, fear, fear. The banking system's falling apart. Because, Sam, you and I talked about when we take a look at Silicon Valley Bank's business model, very, very chunky with startups and techs and what have you. And even more than that, they had a huge amount of their balance sheet in securities, fixed income, massive,
unhedged.
As soon as cash came into the company, instead of parking it at the Fed, having a little bit of excess liquidity, they were throwing it out there onto the yield curve. Again, it's sort of like bank mismanagement, bank balance sheet mismanagement 101, and these people really followed that course. They made an A in that course.
They were passing with flying colors. But I mean, what they did basically is had those chunky deposits, super cheap deposits from what I can tell, and had not enough. They coming in so quickly, not enough places to send it out to, and so they invested a ton into mostly mortgage-backed securities when rates were pretty much zero, and you can't perfectly hedge a mortgage-backed security portfolio and make money on it. So what they did is pretty much leave it unhedged. And I mean, the book value of this company was negative when you include their held-to-maturity portfolio, which you don't really include, which is kind of an accounting gimmick, but nonetheless, mismanagement kind of 101.
And you could probably say the same thing about Signature Bank up in New York. Just unfortunately, this type of stuff happens. When interest rates go up, the value of bonds goes down. Bonds are held on the asset side of the balance sheet, and you know, deposits are the liabilities on the other side. Just accounting 101, Sam and Courtney, is assets minus liabilities is equal to equity or capital in the banking industry. And so when those assets are going down due to higher interest rates and your deposits stay the same, guess what?
Yeah.
Your capital is going down, and that constrains your ability to lend money out. And unfortunately, for some of these banks, they just really did not manage their overall liquidity position very well at all. And so as a result, they had to sell securities, realize a loss, and then the whole thing kind of unraveled.
Yeah, and I think one kind of caveat that's worth explaining maybe a little bit that is somewhat unique to the banking industry is there's two ways to label your investments. And one is available for sale, and those are the ones that you're like, oh, we have a loss on these. But the held to maturity ones, for all intents and purposes, the losses don't really count.
Well, you're holding those things to maturity, so you get to hold them on your balance sheet on an amortized cost basis.
Right.
So you don't really have to mark those things to market. So yeah, you don't really see the loss.
Right. They're there, but
they're there, but they're not there at the same time. It's an accounting gimmick. And Courtney, Sam and I can talk about this all day long,
Yes.
and it's fascinating. I know.
So fascinating.
But when you turn on the TV, when you hear the talking heads going on and on and on, are you really breaking down the balance sheet going, hey, this is what they're doing, the AFS portfolio, their HTM, they didn't have enough liquidity? What does the average person, when they're turning on the TV, in your estimation, when they hear all this stuff, what are they thinking?
Well, for me, now given I do have a different perspective because I do work at a bank, but my question is, it's been 15 years since 2008. Mm-hmm. Why in the world could this have even happened? We've had increased regulation monitoring our balance sheet. We have regulators come in at a consistent basis. This would have been something that they would have at least seen, maybe not exactly what types of bond, but they would have seen the general portfolio. They would have been looking at the balance sheet. And so part of me is like, well, this just brings up that we clearly have holes in regulatory entities, because there's no way that the general public, regardless of us officially bailing these banks out or if it's coming out of a different fund, can feel good about it going forward. Because it's like, okay, well, all right, so no bank can ever fail. The government's always going to step in.
Well, Courtney, you're absolutely right. And with that, we always love to hear from you all. So, Courtney, the thing about regulators is, and this is kind of just those, you're just telling it the way it is, warts and all. Bank regulators really don't come in to tell you how you should run your business. As you know, they come in to tell you how to follow your processes. And so, if you have a process manual, you have a procedures manual, and it could say that we're going to lend our money to Martians. As long as you're following your procedures manual, those regulators get to mark it off and say, look at this, you're doing what you said you're going to do. In large part, that's kind of the way that game is played. Maybe not 100%, but for the most part, that's the way. And making sure that you are doing this, that there aren't any glaring holes and all that stuff. And for someone to sit there and say, hey, as the cash comes in, we go out and buy mortgage-backed securities, for your average regulator, that's okay. It's not, hey, as money comes in, we're going out and we're buying baseball cards. Now,
Right.
that might be the type of thing that the regulators, you can't do that, because there are all kinds of rules and all that stuff. As long as you're following the letter of the regulation and your procedures, they're not going to tell you, hey, don't buy mortgage-backed securities. And so that's the kind of little dirty secret.
Yeah.
Regulators aren't necessarily here to tell you best practices all the time. Sometimes they do, but not all the time.
Right.
They're really here to tell you best practices on how to follow your own procedures.
Right, and I think an important part to that is after 2008, the continued focus on those SIFIs, the systemically important financial institutions, those money center banks,
Yeah.
and there is a completely different level of regulation for the banks that are considered systemically important, which are really those 4 or 5 money center banks, really,
Yeah.
compared to banks that even Silicon Valley being 16th largest, that is not considered a SIFI. So the level of regulation you talked about, sometimes that's important, what you're doing, risk management, all that, the regulators getting into that. It has clearly been shown that has been less of a priority for those banks, even just one tier below those massive systemically important banks.
I just don't. I personally think that we will see some type of regulation come out of this in which they will hold.
I think we already have seen it.
Well, I mean, surely,
Let no crisis go.
Yeah.
right? I
Whatever.
mean,
What's,
there's been plenty of regulators that have made suggestions.
Don't let a crisis go to waste.
Yeah, don't
And
let a good crisis go to
And
waste.
so we'll see that. I mean, without a doubt, we'll see that. It's not going to change anything. It's just going to be another layer of cost on the banking system. And it's also regulators not going to, hey, look at this. Well, duh. Interest rates go up, bond prices go down. And we can't help the fact that, the Treasury threw an additional $5 trillion at the economy in 2020. We can't help that they threw an additional $2 trillion at the economy in 2021. Banking system can't help that the Fed kept the overnight lending target at 0 to 25 basis points for an absurd amount of time, wouldn't let it fluctuate with market rates, and that they blew up their balance sheet by additional $4 to $5 trillion bucks. And so the banking system is actually playing the cards that they're dealt. And so for the government to sit there, oh, you need to do this. Hey, man, we're just dealing with the cards that you played us. And so it's not necessarily the banking system's fault in this part. It's not necessarily Silicon Valley's fault, other than the fact that they didn't have good risk management.
Right.
It's not, hey, there's something inherently evil in the banking system, but ultimately that's the way it's going to play out. In the media, in the press, it's going to be the banking system, there's something rotten in Denmark.
Right, and we've talked about it with, the Fed hiking rates, and we really, for all intents and purposes, up until this last couple weeks, haven't seen a ton of damage from the rate hikes. But the first things that kind of break when you start hiking rates are going to be those that are really poorly managed. That doesn't mean, it's crazy to me that banks were unhedged and basically positioned for rates to remain low forever.
It's crazy.
Those are the banks that we are seeing being punished right now. It's the ones that were not prepared for rate hikes, which is mind-boggling to me. But that is not a systemic problem. This has not been.
That's what I was about to
even
ask.
with
Do you feel
even
like
with
this is
this
systemic?
even with even with these rate hikes and the banks going under, this has not been a credit crisis, even with Silicon Valley Bank.
Yeah, we haven't seen credit spreads balloon
At all.
Yeah.
Well, I mean, if just they're barely moving, and so it's not a matter of loans are going under like we saw in 2008. It's a matter of some places were very poorly prepared for this massive hike in rates and were unhedged, and whether it's greed being a part of that and trying to squeeze, reach for pennies or what have you, it is not something that is largely systemic where it's causing everybody's loans to fail.
So do you feel like, you kind of already hit on it, this is not a systemic issue, but it seems like at a point in time when interest rates were low, it was a smart decision for the bank, and they just didn't adjust their portfolio as rates were increased.
To me, it feels like
it's fair.
picking up pennies in front of a bulldozer kind
Well,
of thing.
and there's a huge element of that, and truthfully, even last year, year before that, there's a huge temptation on even our part, and this is just comments on what we've done here, and that's no offer to buy or sell or anything like that. Huge temptation to go out there and reach for that brass ring, that shiny object, squeeze an additional 50 basis points out of some investments. However, it's been there, done that sort of type thing. Now, let's keep this kind of short. Interest rates have one direction to go, and that's up. And when interest rates go up, these things go down. So let's keep all this stuff relatively short, and that's what we did, And even going out and buying, when we went out there and did that, going out and buying some 6-month bills that just laddered things out 6 months out to 28, 30 months, we're still picking up more than what we were getting at the Fed. So instead of going, I'm leaving 25, 50 basis points on the table, you have to take the viewpoint that, hey, we're picking up 50 basis points from what we previously had. And so that's where experience comes into play, and that's where, frankly, you don't get greedy trying to capture that last penny. Just be
Right.
happy with what you got.
Yeah. Don't turn into Gollum.
Okay, yeah.
Well, you kind of already talked about the brassy ring. I'm going to throw a Lord of the Rings reference
Well,
in here.
I was actually thinking of a carousel. When you go around, you pull the brass ring, you get a free ride. So I wasn't doing a Hobbit type thing.
What carousel do you pull? I'm not aware of that.
I guess, Courtney, I'm so old.
Such a
that I remember when
generational
on the
thing.
merry-go-rounds, you go around on it, and there's always a brass ring. Even at the Birmingham Zoo, there used to be a brass ring. Now, maybe not any longer. It's been years since I've been there. That whoever grabbed it, and you had to lean out just a little bit. Whoever grabbed it, and I'm not going to punch you in the face. Don't worry. Whoever grabbed it would get a free ride. So when you hear someone saying,
As it's moving.
yes.
Does the brass ring then move with you, or is it
you
stationary?
you pull it out. You pull it out of a little holder.
Okay.
And so when you hear people say, you hear that expression, reaching for the brass ring, it has to do with the merry-go-round as opposed to the Hobbit. Now,
Like the Hobbit's a gold ring.
yeah.
Well, it was a ring, so I was and you were talking about greed, so I thought it was
seen
I mean,
I
odd.
the
haven't
thing
seen
about,
any of
and
the
obviously
rings.
we're digressing. She's called me a dork plenty of times because I like numbers. She just showed that she's a dork. She's down with all Middle Earth and the Hobbit and all
Middle
that stuff.
Yeah.
So,
You
it's,
shall not pass. Well,
shape
getting
of an
back-
L
yes,
on
yes.
your forehead.
Well, getting back to it, I think one thing, as you've said, it seems like mismanagement of certain banks. It's
Yeah.
not indicative of the entire banking industry.
Oh, and I've got stats to prove it.
Do you want to talk about your stats
Does
before I go into
He's
my?
already looking at him. I
does,
think he-
does, a
Yeah.
does a 30-pound bag of flour make a big biscuit, Courtney? Of course I want to do that. All right, guys, here it's the point in the program where we get real dry real quick. However, there's something that the Federal Reserve puts out every Friday afternoon called the H8 report. It breaks down the assets and liabilities of commercial banks in the United States. Now, bear with me a second if you haven't already turned off this podcast, but in the end of January of 2008, right before all hell broke loose with the financial system, you take a look at the H8 report and you see that on January 16th, U.S. banks had loans and leases of $6,833 billion. Conversely, they had deposits with which to finance these of $6 trillion, roughly $700 million. So you can $700 billion. So you can see right there, banks had more loans and leases out there than deposits. So it wasn't really necessarily a question of if something bad was going to happen. It's a question of when. And oh, by the way, amount of overnight liquidity that banks had at that time was only $281 billion. fascinating, scintillating stuff. Courtney is glassing over at this point. Now,
Well, this is my second go around with this.
so she's looking at me like, why don't you shut up? Now you fast
Not at all.
forward to the most recent H8 report, Sam, which came out last Friday. Now, the most recent one shows that on March the 1st of this year, 2023, banks, loans, and leases, banks had $12 trillion, $88 billion worth of loans and leases, compared to, drum roll, $17 trillion, $610 billion worth of deposits.
Yeah.
So that loan to deposit ratio is 65%. I haven't done the math, but it's in there. And that's where sitting on those money center banks, really what the feds have done is really ensure that there's a ton of excess liquidity in the banking system. And also to that end, amount of cash that banks are sitting on compared to $281 billion right before the financial system crisis. Here in 2023, cash assets, $3 trillion, $28 billion, and then overnight repos, which is a different one, close to $600 billion.
Yeah.
So we're looking at $3.6 trillion worth of cash in the banking system that hopefully the money center banks in aggregate can use before they have to go selling securities in their available for sale portfolio. As a result, when I take a look at the overall banking system, it's in much healthier shape. The money center banks, which really that's really the financial system for all intents and purposes. When the money center banks have that much cash sloshing about, I can't foresee the crystal ball. I've got a sorcerer's hat, Sam, as you well know, put it all on, and I don't see the next financial crisis, the next recession coming from a collapse in the U.S. banking system.
I agree. I mean, it's just hard to imagine. You know, we've talked about it that we're typically, or at least I'm typically, pretty anti-regulation, not as a whole, but I think I could largely say that. But there was probably some good regulation, or definitely some good regulation that came from 2008.
That's impressive that you're saying
But I
that.
think
The thing is, whenever I say that, I say, I'll deny it if you ever say I said that. But however, you just said it for everyone to hear.
yeah, everyone can hear it. There's a
Yep.
few, but you
It's
know,
recorded.
Meanwhile, Barney Frank is on the board of.
You went there, did
yeah,
you? Did you just go there?
I did.
If there is anything funny that you can be saying about this recent mini bank crisis, Courtney, which I don't think very many people think bank crises are all that funny.
No.
Including yourself. My son, and hopefully John's not listening.
This is what I wanted to get to.
Hopefully John's not listening to this anytime soon. Hopefully he doesn't listen to it at all. My son, John. He's a junior in college, and he sent me a text yesterday. He goes, "Should I take my money out of the bank?" I said, "What for?" And he goes, "All the bank problems." And I said, "No, we good. We good."
We good. But
And again, the thing about it is because guess where he banks?
Oakworth Capital Bank.
Oakworth Capital Bank. And I said, and I told people this morning, I told the story, and I was kind of laughing about it. I didn't tell John this because I didn't want to make him feel foolish. You know, if there's a problem with Oakworth Capital Bank, and there isn't, trust me, by the way, I know our balance sheet, I've helped construct a lot of it, I know our overall liquidity position. If there's a problem with Oakworth Capital Bank or the banking system in general, there are going to be a lot other financial problems with the Norris family than the couple $100 he has in his checking account.
Right.
You
That he's
my
going to
drift?
stuff under his mattress.
So if he wants to take his money out, that's fine. However, that's going to be about the $200 that the Norris family has just in general if there is a problem with the banking system. So, you know, I tell you that story. One, it's kind of funny, and then two, it's gotten down to that level where you turn on the television,
Right.
talking heads are out there screaming and yelling, rolling up their sleeves. The devil's coming to dinner, all that stuff, where a 21-year-old is saying, do I need to get my money out of the bank?
Well, but John, to that point, we look at the media, whether we should or shouldn't, for our news and information, and you do. They're capitalizing on this, and what does the market do? Now we're seeing today the Dow is down 500 points solely based off of the insecurity, I guess, of the banking or people's perception of the banking industry. And so I think part of that is you look at the media and how it's able to manipulate the markets. I mean, what are your overall thoughts? I mean, obviously you're more educated, but do you think this is long lasting, or you think like people will be initially fearful and then will come to their senses once they realize nothing is collapsing?
What I'm about to say are not the opinions of Oakworth Capital Bank or
Yes,
any of that stuff,
disclaimer.
shareholders, and mine only. And when Sam has opinion, the same thing applies. And we do not make a market in any of the securities we're about to mention. All the caveats out there. Anything we say If you act on it, it's at your own risk. All that stuff. Well, lawyers would have said it much better than I would. What we'll likely see, because the big brouhaha this morning is going on with Credit Suisse. They have some problems with their balance sheet, but the thing about it is people have known about the Credit Suisse problem for a pretty long period of time.
Really decades.
Yeah, pretty long period of time, really since the 2008 crisis. The United States really got after it in terms of the regulation. I have to agree with Sam on that regard. Really got after it, really sat on the money center banks much more than the Europeans did, and let alone the Japanese after their 1994 banking crisis. They just kind of created a whole bunch of zombie banks. The Japanese zombie banks are still zombie banks. The European zombie banks aren't maybe as bad as the Japanese, but everyone knew that the European banking system had some issues. And as a result, U.S. banks have nowhere near the same sort of what's known as counterparty risk. The amount of extension of loans and tentacles within one another. So if a Credit Suisse has problems, yeah, they've got some counterparty risk in the United States, but it's not the same as it would have been in 2007 and 2008. In terms of Credit Suisse just in general, that would be like J.P. Morgan or Bank of America to the Swiss, maybe even greater than that.
I mean, that's essentially the national bank.
As hard as that is to imagine. So I can't imagine Bern is going to let Credit Suisse
What's that word again?
completely go under. So that's one of those deals that what they'll do is they'll wallpaper over the problem again. There's really no other thing to do without letting them fail. Wallpaper over the problem again, and you'll see this happen with other European banks more than likely, because after all, they had negative interest rates for a long period of time.
Yeah.
It wasn't a question of whether or not this was going to happen in Europe, it's a question of when. And so you'll see these national governments wallpaper over the problems with their big money center banks, and we'll just keep on skipping down the road, and that should constrain European growth for a very long period of time. Again, that is my opinion and not necessarily those who work with capital plan.
I don't disagree.
I was hoping for so much more.
I mean, we're just so smart, it's hard to disagree.
It's not time for your review, so why don't you tell us the way that you really feel? So, Courtney, we go through all this because some of this was predictable. And I was even talking with the state treasurer, six months ago, talking about this and what the impact it could have on rural banks throughout the country. There aren't as many of them as there used to be. And you heard me mention this earlier in a committee meeting. What I envisioned happening with the next sort of financial system sort of shakeout, you're going to see a ton of sort of smaller banks, community banks, and sort of rural places, 1 or 2 branch type places, maybe $250 million in overall banking assets, where they don't loan out all of their money. So all their money goes into, a huge chunk of the money goes into their securities portfolio, which, as we've established, has been absolutely hit. So you'll see a lot of these smaller banks probably have their book value goes down dramatically, maybe even get to negative, just due to the accounting for the bonds in their portfolio, which will dry up the extension of credit in a lot of these rural communities.
Do you think that a lot of smaller banks will close?
I don't think they'll close. I think there'll be an ultimate, a fair amount of consolidation.
I think that, but I do think SIVB had a unique ability to mess up their securities portfolios and how unhedged it was,
Yes.
especially for mortgage-backed securities, which are, it's any way they move, you're probably going to lose some money just
Yeah,
about.
without doubt.
As a regular investor, how do you monitor that? I mean, other than people of your background and expertise, like how would just the average constituent or whatever person know that this was happening? Because John, you alluded to the fact that this is not surprising, but
Well,
it is to me. I mean,
the thing is, when we take a look at buying an individual security, and we do own some financial names, we do break down the balance sheet a little bit more. It would have given us significant pause to take a look at Silicon Valley's balance sheet and seeing that they didn't have any overnight cash. I mean, truthfully.
Seeing how much was in held to maturity and what they were invested in there and how little was in the available for sale portion of it. And so when stuff starts to hit the fan, if it does, and that held to maturity is no longer held to maturity.
Yeah, and then that gets to be a problem. So we're not, I don't, 4 shares or something like that across all of our accounts, and that was transferred in. we just weren't a buyer of it. So it's a question of absolutely doing your work. Absolutely, when you're going to buy any company, take a look at the income statement, take a look at the balance sheet, ask the questions. And truthfully, for a lot of these analysts at some of these larger firms that are supposed to be analyzing the banking system, to kind of miss that type of stuff, and frankly, I hadn't broken down Silicon Valley Bank's balance sheet, for them to miss that kind of 101 type stuff suggests that maybe a lot of people are getting paid way too much money. Sam, your thoughts on that?
I definitely agree. I mean, people had buy ratings on the company as recently as last Friday.
Well, hopefully they're not going to be paying out big bonuses too.
Well, they did right before they collapsed.
Gosh.
Yeah.
So we probably haven't heard the end of that one. However, I do think that maybe some of the panic of what's going on here
It'll subside.
It's a little bit overblown, and that's when you start seeing corporate credit spreads, and this is getting, if you thought the H8 report was nerdy,
Right, yeah.
maybe not as nerdy as Call Me Gollum, that was up there. That was really up there, by the way.
That's cool.
Yeah. Okay. Again, you're just digging a deeper ditch, you. But taking a look at corporate credit spreads, that's when all of a sudden you start going, "Ooh, okay," and we haven't seen that yet. Sam?
No, haven't seen it really at all.
Yeah. So with that, guys, hopefully we have talked some of you off the ledge, maybe not, but even so, this is how we're looking at least the investment committee at Oakworth Capital Banks, taking a look at this current banking system. I would hate to call it a crisis, but imbroglio, I think, is a decent word for it. But even so, we always love to hear from you all. So if you have any questions or comments, please, by all means, let us know. You can always drop us a line at tradingperspectives@oakworth.com, or you can leave us a review on the podcast outlet of your choice. As always, if you're interested in reading more, hearing more of what we have to say or how we think, you can always go online to oakworth.com and take a look underneath the Thought Leadership tab for all kinds of exciting information. Guys, I give you a last chance to have one last word on this topic.
That's all I got.
That's it, John.
That's all I've got today, too. Y'all take care.